We've got some people joining in. We're planning on starting this thing at 10, so we're a couple minutes early, well, about a minute early. So thanks everybody for joining in. I'm Jordan Pence, obviously, as my name tag says. We've got Ronnie Russell here, regional sales manager with American National. He's really an expert on these products, and American National is a really great partner of ours. And their stated goal over the past couple of years has been to really increase their annuity business and increase their annuity sales. And historically, I'm not exactly an expert on annuities. I know enough to be dangerous, but I wanted to bring in Ronnie, who's a great resource for us to really take a dive into the American National annuity products and explain them and see where their sweet spots are, so we can help you guys identify opportunities and implement their products and so forth. So with that, I think I'll let Ronnie Russell kind of take over from there. Again, I appreciate you doing this for us, Ronnie. I think it's going to be a really big help for everybody that we work with, their businesses, and giving them some opportunity to really help their clients with these products.
Yeah, Jordan, thank you. Appreciate you setting up today's webinar, and also those of you that have taken time to listen in. Thank you for your time, and appreciate the introduction, Jordan. As Jordan mentioned, I'm a regional sales manager with American National for about 10 years now. Been in the industry for almost 25 years. And so today we're just going to talk about American National annuities. Just a brief intro on who American National is. We'll touch on our annuity products, maybe detail a little bit of their features, and more importantly, where to position them, who typically buys these products, right? So this first screen you're seeing, that's a picture of Galveston, Texas. American National is headquartered in Galveston, Texas. That's our home office building. Those of you that may be familiar with Galveston, that's down near the Strand there in Galveston. And so that's our home office. We were founded in 1905. By the Moody family, and been around now for 118 years and counting. Some of you may have heard recently that the Moody family sold out the company 100%. This was May of last year, actually, 2022. Brookfield Asset Management out of Toronto, Canada, acquired us 100%, as you can see there, for $5.1 billion. Brookfield formulated a subsidiary company called Brookfield Reinsurance to essentially hold the asset of American National. So we actually are structurally under Brookfield Reinsurance, but Brookfield Reinsurance is 100% owned by Brookfield Asset Management. And as you can see there, Brookfield Asset Management is a well-diversified, they refer to themselves as an alternative asset management company. And you can see the many different industries that they are invested in. Their investment in American National is actually their first foray, if you will, into the insurance industry, and more importantly, into the U.S. insurance marketplace. And you can see there that, part of their objective in buying American National was the quality, quite frankly, of American National. And I'll touch on that in a moment. But, their goal is to elevate American National into the top echelon of carriers in the United States. You see there, they want to become one of the top 10 universal life insurance carriers in the U.S. and from the Zoom piece, but basically they want to become one of the top 5 annuity carriers in the U.S. Over these next 5 years. Just to give you a sense, just to give you a quick sense, in 2022, we did about 1.5 billion in annuity new premium, which historically was about what we would average annually when the Moody's owned the company, and 5 billion in annuity premiums. So Brookfield is focused on the annuity business, and and are committing the resources to get us there. I mentioned a moment ago that one of the reasons Brookfield selected American National is indeed the quality of American National. American National is most certainly one of the most conservative and disciplined insurance companies in the industry. You see here that we've been AM Best rated A for over 82 consecutive years. As you guys know, AM Best is one of the primary rating agencies for the insurance business in the U.S. What's relevant of this is that, as many of you may be aware, there's less than 20 insurance carriers in the United States that can make this claim, that they have consecutive A or better ratings by AM Best. And again, this is one of the reasons Brookfield selected American National, because of its quality, its discipline, and its reputation in the industry.
Wow, that's an interesting statistic that I didn't know. That's cool.
Yeah. Thank you, Jordan, for highlighting that. So let's talk about annuities. I mean, obviously, we're going to get to product here in just a moment, but beforehand, which is very critically important, is contrary to life insurance, there is suitability training requirements for annuity business, and so we wanted to highlight this here from the start, because the worst thing that can happen to you is to potentially submit an annuity application only to learn you didn't complete suitability training beforehand, and so then we'll have to require you to go take another app. So if you see here, this is our website, lad.americannational.com. When you go onto that website, you see here at the top right corner the various tabs. You see clicking agent resources. You get the drop-down menu that you see to the left under getting started. You would click agent required training under required training tab. And then that takes you to this screen where you'll see product-specific suitability training. You would come down and click to go to my learning plan. If you're not already appointed, you would click there at not appointed, and that way we can direct you to proceed and complete your suitability training while you're getting appointed. So you'll be ahead of the game and ready to have completed suitability training for going out and trying to obtain business. So that's the first two slides regarding that suitability. So just make a point of making sure, if you're going to have conversations with clients about annuity solutions, that you make sure you have fulfilled the suitability training requirements. So going back again to our website, you'll notice here at the very top right, there's a tab for rates. And so you would click on that rates, and then you'll notice down at the bottom, we have American National Insurance Company on the left, and we have American National Insurance Company of New York. So we do have the New York company for any of you listening in where there might be some New York business that you have access to. Just know that we also offer these products in New York. But once you hit the rates at the top, again, you would select which company, and then ultimately you would click on the current interest rates. Of course, we also maintain last month's rates as well for comparative purposes. And then this is the rate sheet. Apologize for the small print, but basically what you're looking at is a combination of our different annuity products by the individual boxes. Like right here where I'm circling my mouse, that's going to be our fixed indexed annuity rates. Over to the right of that is our fixed annuities, and its of course its rates as well, and so forth. So we'll get into these we'll get into each of these products separately, but I wanted you just to have a sense of here's where the current rates are that you can access, so you would know where the rates are for the different crediting strategies. So let's talk about our products. The first product we'll talk about is our single premium immediate annuity, which is a SPIA, right? SPIA. You'll hear it in the marketplace referred to as a SPIA. Most of you are probably familiar with this product. We offer obviously brochures for this product in both English and Spanish. And the single premium immediate annuity, its target audience is going to be predominantly older clients in their 70s and 80s. Mostly because they're looking for guaranteed income, and more importantly, they're going to be fearful. They're typically fearful that they're going to outlive their money, so they'll position a portion of their retirement savings and send that to us single premium, and we will convert that into a monthly income for life. And as you see here, some cross-selling opportunities. Since we do have the ability to short pay our life products, be it our IUL or our GUL, you could use the SPIA for a short pay scenario, whether it be a 5-year or 10-year type of short pay scenario for the life solution, and just use the SPIA for that annual funding.
Ryan, that brings
and
up
as
a
you can see
point
here, obviously.
Yep. Sorry, I was just going to say, does it go straight? Can American National just make it go straight from the SPIA to the life insurance?
No, that's a good question, Jordan. It
Okay.
does not currently. That's something we're looking into. But essentially, what would happen is the client would receive an annual payment from the SPIA, and then they would turn around and write a check for their annual premium for their life policy.
Which I guess we could just draft out of their bank account anyways.
That's correct. Yeah, because
so
generally what will happen when we fund the annual payment to the client or monthly payment to the client, we're going to do an EFT into their bank account.
Right. That makes sense.
So that's really who your target market is on the single premium immediate annuity. It's pretty straightforward. What I can tell you is that historically and even currently, American National is going to be one of your top SPIA providers. Typically, the SPIA is a spreadsheet comparison product. But when you run those spreadsheet comparisons, you're going to find that American National is going to be in the top 1, 2, or 3 carriers. So just keep that in mind that if you get an Annuity SPIA quote, it will be one of the best in the industry. So let's talk about our fixed and bonus annuities. So our fixed annuities, as you can see here, we have our Palladium MYGA, our MYG multi-year guarantee annuity, our Palladium MYGA. We have 2 WealthQuest products, Citadel 5 and 7 Diamond, and Century Plus, which is our fixed annuity with bonus. So the Century Plus is the only fixed product we offer with that bonus that we'll touch on momentarily. So you see our Palladium MYG annuity. It's obviously going to be suitable mostly for clients in their 60s plus. And as you guys know, listening in, it's basically a CD alternative. We offer this product in a 3-year and 5 to 10-year term options, and at a fixed interest rate for the term of the contract. And so that's typically what we're seeing. A lot of activity is in the 3-year and the 5-year, obviously, because clients don't want to necessarily lock down their money for extended periods of time. But that 3-year or 5-year is definitely more competitive than any CD that they can get from the bank. Obviously some cross-selling opportunities. It's just the option to maybe stabilize the client's investment portfolio, so they can have some fixed growth if maybe they're heavy on the equity side. And equally, we can take both qualified and unqualified money for our MYGAs, as well as all our annuities, actually. So, there might be some opportunities to reposition some qualified funds out of IRAs as an example. So let's talk about any questions on that, Jordan? Do you have anything come up?
Well, I was just gonna say that's a really good idea. Instead of buying a bond, you could just buy one of these multi-year guarantee annuities in somebody's IRA or whatever, to as an alternative. And I mean, it's almost as good as a CD from guarantees. I mean, it's not backed by the government, but it's pretty close.
Yeah, no, that's absolutely right. I mean, obviously it's, as with any insurance product, it's subject to the the claims paying ability of the carrier. But, again, with our history and longevity in business and our quality of rating, that should reassure the client that American National is not going anywhere.
Agreed.
So let's talk about our indexed annuity. Our indexed annuity or our fixed indexed annuity, as most of you are familiar, it's like an IUL, right? It has an index opportunity for the client to earn growth of their premium dollars. And this product comes in two term period options. It comes in a 7-year as well as a 10-year. We refer to this, you see this product is the Annuity Strategy Indexed Annuity Plus 10. So we refer to it as our Asia for ASIA, our Asia Plus 10 and Plus 7 product. So you'll hear this product referred to as the Asia Plus. So, who's that target market? Typically that target market on indexed annuities is going to be your clients in their late 50s and 60s. Obviously they're approaching retirement. They can't realistically keep all their investments in the market. And so they're looking to maybe, diversify some of their retirement savings into something that's going to be safe. Like the IUL, the index annuity has that zero floor protection. So there's no risk of losing principal, which is the appeal, if you will, for clients in this age bracket. They'll allocate a portion of their retirement savings in a single premium form and position it in this product for that purpose. Additionally, this product does come with a flexible premium option, where for a small amount of an initial premium of as little as $5,000, a client can open up a contract and contribute to it on a monthly basis for as little as $100 a month EFT. So if they set up an automatic draft for as little as $100 a month, they could also have this annuity contract. And in that sense, that's where this might actually fit some younger clients, right? So, not only is the single premium is more targeted for your older clients, but the flexible premium option could be positioned for your younger clients who want to build and accumulate savings. Obviously, some cross-sell opportunities, similar to the fixed annuities. It's ideal for rollovers out of maybe a 401k to an IRA or an IRA or Roth. So again, as mentioned about the fixed annuities, this indexed annuity can accept both qualified and unqualified funds. So going a little deeper on this Asia Plus, because it's an index annuity, it does have multiple crediting strategies. And what you're seeing here, and again, apologize for the small script. I referenced our website earlier, where you can actually go out on our website and navigate to the Asia Plus product and see this piece online and take a look at it. This is just kind of highlighting some of the features of the product. I mentioned earlier, for example, to open up a contract, it takes a minimum of $5,000. That's going to be for qualified money. You'll notice there at the top that unqualified money is going to require at least $10,000. And so you see here that this kind of highlights the different crediting strategies. This product also comes with an income rider. And then you see here down towards the bottom, it outlines the surrender table. that's applicable for, if the client were to take an early surrender. But we're going to go a little deeper, if we could, on our crediting strategies, just so y'all have a sense of, what are the crediting strategy options, and, just generally, how do they work? So you'll notice we've got, as I mentioned earlier, 7 different crediting strategies. And we'll start here with the declared rate. Of course, the declared rate's pretty straightforward. That's going to be a 1-year declared rate, almost like a fixed annuity, where we're going to set that rate at the beginning of the contract year and credit the client's account 365 days later, right? Based on that interest rate. So you see here the example, $10,000, it's a 1-year segment term, declared rate of 1.9. That means at the end of the year, the client would be credited $190 on top of the $10,000. We have what we call a specified rate. You'll notice that specified rate is much higher than the declared rate. And how this works is it's basically saying that if the index, whatever index you're allocated to, the S&P 500 in this case, if the index does 0 or positive, you will get credited 3.4%. And of course, if the index does negative, well, then you get the 0% floor protection. So sometimes this strategy can be a convenient strategy if you wanted to maybe diversify the contract with multiple crediting strategies, and maybe allocate a portion of the account or the contract account value into this, so every year there's a good chance you're going to get a decent interest rate on a portion of your account value. But again, similar to the declared rate, obviously positive. Doesn't matter what the positive is on the index, you're going to get 3.4%.
Huh, that's interesting. Is it currently 3.4%, the credit, or is it some different number?
I think it's a different number, Jordan. I can't remember offhand what the current is. That's actually going to be in that rate sheet that was highlighted earlier. So, but yeah, I think if this is a crediting strategy that's of interest, I would always promote it as, hey, diversify the whole account, maybe blend a couple of different crediting strategies together and allocate a portion of it into this specified rate.
We had somebody ask a question regarding additional contributions. Where do they get allocated to? So like if you're doing maybe like a monthly contribution after the annuity is set up, where do they get allocated to?
Yeah, so what happens is, if you've already got your contract set up to be allocated, let's just say 100% into the declared interest rate option, every month when you contribute, that contribution will then obviously be allocated 100% to that declared rate. Accordingly, yeah. And then of course,
wherever you set up the allocations initially.
Yeah. Now you can change it. You have the option to change the direction of your allocation on an annual basis.
Okay.
So the monthly sum, just to give you an example of how that works. So you'll notice if we have 12 months and we log in the individual monthly change of the index, the S&P 500 as an example, you'll notice the only challenge sometimes with the monthly sum is negatives do get added in to the summation. So you'll notice if the monthly cap, which let's say is 1.9%, you'll notice that if the index changed in month 1 by 4%, well, we're going to limit that to 1.9. But on the downside, if you look at month 3, if the index fell 3%, you're going to take the full hit of the negative 3%. And then you'll notice what happens is we take that monthly cap on the top side, summed up with the negatives on the downside, and average that out.
That makes sense.
And that's how you determine what interest rate will be credited. But a hypothetical example number two, you notice if you have had some severe negatives on any given month of the S&P index, it could greatly impact. In this case, it was negative 2%, and so you would earn 0% for the year using the monthly sum crediting option.
Yeah,
Does
that's
that
one
make?
always it gets confusing to me, but it makes sense the way that you're explaining it.
Yeah. Okay, good. And then, typically I would tell you that this is generally where most contracts are allocated, the annual point to point with a par and a cap. You'll see here it's a 1 year point to point. In this case, it's the S&P 500. You could choose the 100% participation or the 50% participation. You can see the cap differences. Usually, I think, again, probably for simplicity's sake, for explaining to clients, most agents just go with the 100% participation. But you can see here the cap is as high as 10% on the 10-year contract. That 50% participation would be, as an example, I think in 2023, they said the S&P 500 index did well over 20% return. So if you're in the 50% par, let's say that we'll say the market, the S&P did 24%, and you get 50% of that, so that's 12%. You're still below the cap. If you were in that crediting strategy, or that if you were in the 100% par cap, you would only get credited the cap of 10%. Does that make sense?
Yeah, that makes sense. You'd have to have an exceptional year to be better off in the 50% par rate one.
You would, and that's why, what we see typically, Jordan, is most agents just go with the 100% par because, excuse me, it's just easier to explain to a client as well. They understand it better. And you can see here, working our way down, we have the NASDAQ 100 with just 100% par and that 10% cap. And then you'll notice here, we do have an interesting crediting strategy, our S&P Mark V. This is a volatility index option. You can see here the participation rate's 210%. So, this one though, this particular index is typically going to average around 5%, because it's constantly moving funds in and out of the index subject to the VIX. So for some of you that may be familiar with the VIX, which is the volatility index in the market, that index is really a barometer of the VIX. And so, but it does have that 210% participation.
That's pretty high. And no cap, right? That's uncapped.
Yes, that is uncapped.
Yeah, man.
So that's something to look at. Again, if you have, in my opinion, if you have a client that maybe isn't so investment savvy, probably the S&P 500 annual point to point 100 participations where I would park them.
Yeah.
If they are a little more investment savvy, now maybe you can introduce location adding up to 100%.
Yeah, I always am worried about recommending too much in that Mark V, because when the market does good, sometimes that's pretty flat, and that's a tough conversation to have sometimes when the market did 20% and you got, a couple percentage point credit.
Yeah, no, you're right about that, Jordan. That is the only risk with that Mark V. It's really going to do more favorably in a down market than an up market.
Right. Yeah.
So I mentioned the point to point crediting. Again, it's basically we are taking the time frame of a 365-day calendar year, looking at the S&P between those two dates, and that's how we end up defining the crediting to the various crediting strategies that we just discussed. Like that uncapped strategy, where we have the uncapped, you'll notice here, if we have the annual point to point, right? And if the index annual growth is 10%, and a par of 40%. It's kind of like that example I just used on the last page with what the S&P did in 2023 of say 24%. You can see here that you do run the risk on those low pars of not necessarily doing well if the market doesn't do well. So, but again, it's just number of options. And then Jordan, as you kind of talked to on this S&P Mark V, similarly, even though it does come with a high par, you see there that if the growth rate is around 5%, which is typically its target, even with a high par, you may be going to get 10% if it's 210% par. This example is 120% par, and that's where you would get that incremental increase over the actual growth rate.
Yeah.
Similarly with the NASDAQ 100, kind of in line with the last two slides. That's all really this is talking about is how the pars, which is simply just the participation rate, might be calculated, whether it's 100% or in the case of the S&P Mark V, the 210%. Asia Plus, it does come with lifetime income riders. There's actually 2 lifetime income riders available. As you see here, we have one. This is going to be specifically on the 10-year product that we're going to discuss. It's 9% fixed rate. You'll notice there is a fee of 1.1%. So how that works is, for those of you that may not be familiar, if you look at an annuity contract and you see a statement that shows the account value going forward, if the client elects a lifetime income rider, then there will be a second, if you will, almost like a phantom account that will be tallied with the statement that will reflect a 9% annual credit based on the account or based on the initial premium going in. So if I had a $100,000 single premium contract on the income rider ledger in year one, at the end of year one, I would have $109,000 in the account base. That is subject to the indexes. That could be anything, right? It's going to be a function of the index. But the income rider ledger is separate, and it is going to compound at 9% if you elect the lifetime income rider with the fixed rate. Conversely, on the opposite side, you'll notice we have a fixed rate plus the index credit. So in this case, if the client elected the S&P 500 index annual point to point as their index crediting option, then then they selected the lifetime income rider with the fixed rate plus the index credit, then at any given year, their credit for the income ledger would be 4.2% plus however the index did. So let's take, for example, 2023. If the index did over 20% return and I'm on the annual point to point with that cap of 10%, then in 2023, my income credit or my income ledger credit would be 14.2% as opposed to 9% if I had elected fixed.
Are both of those
that's kind of the trade-off between those?
Oh, sorry. Are they both compounding or is it simple interest?
No, they're compounding, Jordan.
Wow. Okay.
No, they're compounding, Jordan. So in year 2, let's take, for example, the fixed. In year 2, the 9% will be based off the $109,000 from the example I used.
Right. Oh,
right. And then the fee that you see there, the fee is actually being assessed against the account value. So the account value will show whatever it earned in any given year less the fee. So you won't see the fee deducted from the income ledger.
that makes sense.
That's what, yeah. So that's what the lifetime income rider Again, this is just a rider. The client could elect to have our Asia Plus contract with no lifetime income rider if they chose to do so. If they want a lifetime income rider, this is the options, and there are the fees. Obviously, it will give the client after year one, through the life of the contract, the option to convert that contract essentially into an immediate annuity. And so that would be the feature available to the client if they wanted to at least have that option down the road, that they could convert the contract to an immediate annuity and convert it to a fixed income for life.
So the fixed rate seems pretty common. I mean, it seems like that's sort of like common with other FIAs, but this fixed rate plus index credit seems like a pretty unique offering. Is that the case?
Well, yeah, and Jordan, I'll tell you, if you look at LIMRA statistics, for example, if you look at LIMRA statistics say that 1 out of 10 income riders on a fixed indexed annuity are exercised by the client. Typically, clients that elect the lifetime income rider are doing it as a security blanket and not much more. And here's why. What happens is, remember, I mentioned you have your account value ledger and you have your income account ledger. So at the end of 10 years, let's say that $100,000 on the income ledger side obviously grew to more than 200,000 because we're compounding at 9% as opposed to 7%, right? So the income ledger at the end of 10 years, let's just say, so I don't have to try to do math, and is $225,000.
Right.
Well, what if on the flip side, the account value didn't do that well? And let's say the account value is $175,000.
Right.
The client now has two options. Do I take my $175,000 account value and the contract terminates because it's completed its 10-year term, or do I take the $225,000 income account value and convert that to income for life? And of course, if they elect that option, we have basically income factors. So there will be an income factor or a percentage that we have tabulated by age that would then be the multiplier to the income ledger account value to determine their income for life.
Okay,
and so I think what happens with most clients is at the end of the term, they don't want to lose access to the money and they end up walking away with their account value. The reason for that lengthy explanation, Jordan, is for the reason you just brought up. If you look at the fee is 30 basis points cheaper with the fixed plus the index.
Right.
So my line of thinking to the client is to tell the client, look, I understand you want this as a security blanket, so to speak, but in the event you never exercise it, let's not let this thing charge excessively to your account value. Let's go with the fixed plus the index because it's less expensive.
Yeah, and the reality of it is you only really need to average 5% basically or greater to beat the 9% anyway. So that's not really that big of a hurdle. You could get close to it with almost like
correct on the index side.
Right.
Yeah.
There was somebody asked.
Well,
sorry, I didn't mean to interrupt. Go ahead.
No, go ahead.
I was just going to say, somebody asked, are there any penalties for annuitizing with the LIR in the early years?
No. So the only, again, obviously income factors are going to be relevant based on age. And so obviously the younger you are, the lower the percent on income factors. And of course, if you're in the early years of the contract, you haven't really given it a chance to grow and increase in value.
Right.
So, it's kind of a double-edged sword if you exercise early on. I think if you're planning to exercise early on, you're better off looking at the single premium immediate annuity instead of this product. This product is really going to be more for, hey, I'm 60 years old. I want to run this thing till I'm 70, and then I'll evaluate the income option versus maybe taking my account value and flipping that into a SPIA directly. And that's kind of how I would position it with a, say, a 60-year-old client for a 10-year, for a 10-year plan.
Yeah, that makes sense. Yeah, that makes sense.
Okay. Let's see, moving along. Just some, I mentioned early on about our brochures. Some of you may already be familiar with this. Some of you may just go to, to Ralph or Jordan for this. But if you wanted to do it directly, again, we're back to our website. You see here I went to the expert office. You see the drop-down menu over to the right, resources. I'm hitting supply orders. I can order brochures through that supply order. Over to the left, as I showed you, you see Expert Illustrator. You can go to our Expert Illustrator to run annuity illustrations, for example. You see here Expert Forms to the right. This is where you would get an annuity app if you wanted a paper app, but we are now 100% Firelight for those of you that may not be we utilize. And as you can see here, that's under the submit, start an application. That's our expert app and Firelight to submit annuity applications electronically. We would most certainly emphasize and promote submitting annuity apps electronically, similar to life apps. It's going to guarantee an in good order app. So just keep that in mind. But once you hit start an application, you have the option to go with our in-house internal expert app platform or Firelight. We're gradually transitioning everything to Firelight, and it will be available on our website. So just know that.
So Firelight is going to be the only option in the future.
For annuities, yes.
For annuities, yeah. I mean, I've used it before. It seems relatively simple.
It is, Jordan, and that's across the boards. It's predominant Firelight.
Yeah, it seems the case.
And then one last point: if you're appointed with us on the life side, it's your same appointment on the annuity side. We don't have separate producer codes for life or annuity at American National. So if you're already appointed with us on the life side, then consider yourself appointed on the annuity side. All you would need to do is to complete that suitability training I mentioned early on, and you're good to go. So I mentioned earlier, if you do start application, you'll notice you see here it comes up. Are you doing a life product? Are you doing annuity, our MYG or Asia? Or are you doing our SPIA or our fixed annuity, Wealth Quest or Century Plus? And then you would start your application. So those are the options when you start via the Firelight for the annuities. And then I mentioned earlier, back to our website, just to give, I referenced some of this, actually all of this information we discussed is on our website you see there the products and services. You see there on the indexed annuity, you have the option of the Annuity strategy plus 10, as well as the plus 7. You would go there to the product specific website where you can, see all the information we've discussed today at your own leisure.
That makes sense. And the chief difference between the 7 and the 10 is
once you're in that Asia
sorry.
Plus website, product specific. Well, it's two things, Jordan, the 7 and the 10. The 7 is obviously term period, 7 years versus 10. The caps are a little lower. The reason we have the 7 was originally built for security licensed advisors in our broker dealer channel.
Okay.
most independent agents, they don't even look at the 7, they go straight to the 10.
Makes sense. Better caps. I mean, why wouldn't you want that?
Yeah, and the comp's higher too. So, but
That doesn't hurt.
yeah. So once you're in that product specific website of, in this case, the Asia Plus 10, you'll notice we have product presentation videos. You notice there the required training. You can go there as well and click on required training to, complete the suitability training for the product. And that's really it, Jordan. That's kind of a broad overview of the products, a little bit about our website and maybe how to find that information. Just if at this point, if you'd like, you could open up to more questions if there's any.
Yeah, no, thanks a lot, Ronnie. That's really good information. And I do appreciate the insight. I think it's really helpful. Yeah, anybody can ask any questions. There's a Q&A thing in Zoom or the webinar thing that you could use, or the chat, which I'm monitoring right now. But feel free to type anything in. I hate to open up the voice because it can get a little messy if somebody's in the car or whatever,
Right.
But yeah, feel free to ask any questions. Thanks again, Ronnie.
Welcome.
It's been really good as far as information. What we'll do, me and Brendan's in here as well in our office. We'll be reaching out to everybody and see if you have any individual questions, or if we can help you guys run any illustrations, or if you'd like any illustrations, we'd be happy to assist. But somebody asked, will this presentation be emailed? I don't know if Ronnie's able to give it out, so I'll leave that up to him.
Yeah. Jordan, I can email it to you after this presentation and you can distribute it if you'd like.
I appreciate that, Ronnie. We'll do that. So to whoever asked that question, yeah, we'll follow up with you and get it over to you. So there's somebody that asked, what is LAD versus what's on Agent Central? I must be talking about the agent portals or something.
Yeah, well, so LAD is just our new distribution name, which is Life and Annuities. So we're the Life and Annuities distribution channel. I know you guys previously, Jordan, were under the multi-line.
Right.
Multi-line of American National was rolled into along with our independent channel, which is the channel at American National I initially belonged to. And so we combined the independent channel with the multi-line channel, and together we are now LAD, which is Life and Annuity Distribution.
Yeah, and frankly, I used to hop on the LAD website, formerly the independent website, to get marketing material for the products. So that's where I used to go get it. So anyways, but
yeah, we always had better stuff on the independent side. So, and now we're combined. So it's more convenient actually for all agents that are working with American National.
Yeah, that's for sure. Let me ask you one thing that we didn't talk about this before, but do annuities count towards any sort of incentive trip or anything like that for 2024?
Yeah, actually, it's a very good question, Jordan. I didn't address that. It does. Typically, what we do is we give 0.05. So if an agent does, let's say in 24, $1 million of premium with us in annuities, we'll take 5% of that and put that towards our incentive trip purposes.
Oh, wow. So 50,000.
50,000. Yep.
Wow. And is there any sort of mix that you have to do, like half life or?
Yeah. So we generally require a minimum of 12 life apps. And typically we require, I want to say, Jordan, it's at least 5 annuity apps. So in other words, we don't want an agent to do $1 million case on one annuity and then get that 50,000 points of credit, gets them to the incentive trip, and they just wrote one annuity with us, right? Maybe they did.
Want to see a few.
Yeah, yeah,
So yeah, that makes sense. No, well, and it's Ireland next year. I saw the announcement, so
yeah.
that's
But no, they
exciting.
do get credit towards. Yeah, yeah.
Excellent. All right, I think we answered all those. If anybody else, we'll follow up and shoot us an email or anything like that, and we'll catch up. Thanks again, Ronnie. I appreciate you taking up so much of your time to do this for us. I think it'll be really valuable for everybody, and
Good.
we'll be in touch to all the attendees.
Okay. Thank you, Jordan. Thank you for those of you listening in, and I'll send you this this PowerPoint here shortly, Jordan.
Thank you. We'll talk soon.
All right.
Thanks.
Yes. Thank you. Bye bye.